Hi, this is about Chapter 11, Number 3, homework assignment on depreciation methods and change in methods. This question is considering two different methods. One is straight line and another one is double declining method. It's basically explaining there are two companies that we are reviewing, and one is using straight line and another one is using double declining. And in order for us to compare the two, we need to make the depreciation method same so we could compare them. So it's in this scenario, it's telling us that company A is using double declining method and company B is using straight line method. And this is the information that we gather from company B. Company B is the one who's using straight line method. So straight line method is easy, right? You have cost of the asset. From there, you take out residual value if there is such, and then you just divide it by the years of the asset's life. In this case, it's 10 years. So how do I know it's 10 years? Since this company B is using straight line, we could kind of gather information based on the information given here. It says the asset cost was 115,000 and it had no residual value. So if it's 115,000 and its annual depreciation amount is 11,500, then if you divide the two, you could see that its useful life is 10 years. So 115,000 divided by 11,500 would give you 10. So we could gather that it is 10 years that this equipment or the asset has useful life. On top of that, on 2016 balance sheet, it showed as 115,000 minus accumulated depreciation, 46, would give you the book value of 69,000. So how many years since it's been depreciating? If we divide 46,000 by 11,500, you will see that it's been only 4 years. So for 4 years, this company has been depreciating for straight line using straight line method. So we had gathered some information. This equipment costs 115,000 and it has useful life of 10 years. And this company has been depreciating for 4 years and there is no residual value. With that, it's asking us to calculate this depreciation using double declining method. If we are to use double declining method, this is how we do it. You start with the depreciation base, same as any other method. From there, we multiply the depreciation base, meaning the cost, times by the 2 times of the straight line method rate. So what is straight line method? Straight line method is 1 over 10 in this case. Why? 10 is coming from 10 years, the useful life. So 1 year depreciation amount is 1 over 10, isn't it? So for double declining method, once we get that 1 over 10, which is 10%, that straight line method rate, we multiply that by 2. That's double declining method rate. So in this case, it will be 0.2. We'll multiply the depreciation base amount by 0.2 or 20%. And once you multiply that amount, you will get this annual depreciation amount. So 0.2 times 115,000, you get 23,000. Then the depreciation base amount changes by 23,000. So how do I got this 23,000? I mean 92,000. That is the amount. 115,000 minus 23,000 equals to 92,000. So for the second year, for double declining, we will multiply 0.2 by 92,000. Then you get an annual depreciation amount that's slightly less than the previous year. So again, the third year's depreciation base amount is, you could see that that amount is coming from 92,000 minus 18,400. That is third year's depreciation base. Or you could say that total accumulated depreciation, meaning accumulated depreciation is the total of 2 annual depreciation amount. This is taken out from original amount, 115,000. Then you will get 73,600 as well. So you could see that double declining method, depreciation base change every year instead of having same amount every year like straight line. So your answer to the first question in this case is this. It's asking basically recalculate double declining balance method for first 4 year. So this is the answer. How did we get it? Just basically just calculating it using double declining balance method. So here's the answer, this portion. Notice if you would do this all the way to up to 10 years, it doesn't quite get to 115,000 as it should. It doesn't. So toward the end, for double declining balance method, we have to make an adjustment so that it will be completely depreciated, because it didn't completely done. It still had book value at the end. What happens is in real life scenario, companies make changes in changes to the depreciation method to a different way. Like they might start as out like this, and then toward the end they will change it to straight line. If they're not going to do that, they would have to make arbitrary numbers, so it will be depreciated completely. Then the next question is asking, what is it saying? If the company B decided to switch depreciation method in 2016, which is the 4th year, right? If you look at up here, the answer, since it's been depreciating 4 years and it started from 2013, in 2016 it would make it 4th year. It's saying if the company switched from straight line to double declining balance method. So we are switching from straight line to double declining in 2016. And it's asking you to prepare 2016 adjusting journal entry to record depreciation for the year, assuming no journal entry for depreciation in 2016 has been recorded. So 2016 hasn't been recorded yet. We only recorded 1, 2, 3. 3 years been recorded. So we have to look at the book value based on 3 years depreciation made in this scenario. So I did a little graph here. So if you were doing straight line, you would have something like this. Every year you will be depreciating. It's not a straight line. Straight line rate will be 10% every year because it's 10 years useful life. So on the 3rd year, your book value will be 80,500. If you add this together, for 3 years, if you take it out from 115,000, you will have 80,500. So at that point, is you wanna change it to double declining method. So if you do that, at that time you will have a book value of 80,500, right? And the method is saying you have to multiply 2 to the straight line method rate. So how do you get straight line method? So you could see here, you get a straight line method by dividing 1 over how many ever years you have left. So up here, when we first did the double declining balance method with 10 years, we said the straight line method rate was 10% because 1 over 10 would make it 10%. But here at this point, after we already made an depreciation for 3 years, we only have 7 years left. So at that point, you should only depreciate 7 more years. So the straight line method rate will be 1 over 7. If you do 1 over 7, you're going to get something like 14.28, something like that. So for double declining balance, you have to multiply 2 times to that rate. So if I do that, meaning here you can see 1 over 7 times 2. If I do that, you're going to get something like 28.57. So this is wrong. You will get number something like this. Or here is my just extra calculation. You could see right here, formula is this amount equals to 1 over 7 times 2. So you get this kind of ratio, this number. So to calculate double declining balance method depreciation, starting 4th year, because 1 to 3 was already used up using straight line. Starting 4th year, I'm going to use this amount. At that time, book value was 80,500. And every year, I'm going to just multiply this rate, which is made up with 1 over 7 times 2. So if you multiply that, then you'll get an annual depreciation of 23,000 for the year 4. The next year will be different. The base amount, depreciation base amount will be your original book value minus last year's annual depreciation. And that will be the new depreciation base times the same rate, double declining balance rate, which was calculated right here. And then your annual depreciation will be that. So it will change every year. And if you continue that on year 10th year, you still will have something left. So you would have to make an adjustment so that there will be nothing left over. This book value should become 0. So we would have to make an adjustment toward the end.